Money Mondays.
Welcome to Money Mondays.
Yeah.
We are now past the election, so now we can start to focus on real estate again. So,
thank God, man, that was freaking buzzkill. You know? But hey, we'll see. We'll see what the next year holds. Hopefully, a lot better things than 2020.
A lot more acquisitions, hopefully.
Yes, God willing.
Hopefully, a few more stimulus is in there.
There'll probably be a couple more. I think ultimately there are some people that are in need of that, and I'm in support of that to an extent, right? You guys got to be smart about it. But anyway, your hosts Ben Ferris, Disrupt TV Studios, right here in Houston, Texas. And once again, this is Money Mondays. When do we do this, man?
Every Monday, 3:30 Central. So for those of you just tuning in, it is 3:30 Central.
So we try to keep it to 30 minutes, everybody. We don't want to waste everybody's time. We want to get
a 15, 20-minute presentation and 10 minutes Q&A.
Yeah, we love the Q&A. We like it to be interactive. We want you guys to ask questions, make comments, right? You could say, hey, I think that's BS, or yeah, I totally agree with that, right? We want it to be interactive. And we'd also like you guys' help too. Give us some stuff that you guys like to talk about, right? We don't have to just talk about multifamily. Yes, that's where, obviously our background is in real estate, but we can talk about a lot of different things, right? We can talk about other real estate. We can talk about being a business owner or being an entrepreneur. So, but today, what's today's topic, man?
Today's topic, we are talking about how to refinance your multifamily property. Why are we talking about that, Ben?
Because we just did one. This is about as fresh case study as we've probably ever done. So we closed on it, not this last Friday, but the Friday before that, right? It's a little bit over a week and a half ago, and it was a little bit more of a challenge than I think we were expecting. I think we thought it was one of those ones, but we already own it, so it's just gonna be real easy. But, at the end of the day, it was like a full-blown acquisition minus the equity raise. So people just need to understand that that's kind of how it is, right? Don't expect that the refi is just going to coast on through just because you own the asset. They're looking at every little thing. And so we're going to get into the good, the bad, and the ugly. So for people that don't know this story already, that aren't our investors or maybe our close family and friends, what's the name of the property? Where was it at, man?
Alamo Oaks Apartments, 282 units, 4511 Northeast. I think that's right. I'm just totally guessing the address.
You're pretty close.
But it's San Antonio.
Was it 1451?
No, 4511.
It said Northeast San Antonio. Yeah. So for people that don't know, maybe you're out of state, right? San Antonio is about 2.5 hours west of us off of I-10. And so we get out there pretty frequently, and this is one of two assets that we own out in San Antonio. We love the San Antonio market. You have to realize that it's different than all the other Texas markets, right? It's all got every one of them's got uniqueness and good things going for it and challenges. This is like no other, right? But San Antonio, reason that I like it, on a cost basis, you're usually going to get a lot better of an asset for a lot less.
Absolutely.
On a basis.
Price points make sense. Yeah. Nice growing economy. So it's a place that we do like. It's more of an operator's market. Yeah. But hey, that's the opportunity for us. So
what does that mean, right? You have to really be tight on the management side of this, right? You have to watch your rent. You have to watch your expenses. You have to be. This is not going to be one of those deals that you're just going to coast into appreciation. It's not going to be like an Austin or a DFW deal, where you're hoping to sell it to the next guy or gal for a lot more money. And don't get me wrong, there's appreciation that's happening in San Antonio, but you got to force that, right? And you can only do that through tight operations like Ferris mentioned. So let's talk about some of the numbers, man.
Yeah.
So what do we buy it at?
So maybe a couple things. So I don't even remember. We bought it about 18 million.
Yeah.
A little over 18 million. But let's talk about what happened during closing, right? So on this deal,
get into that.
Right?
All right.
This is where Ben and I, unfortunately, we probably have PhDs in lending. We've experienced a lot, we've seen a lot, and that makes us stronger, and we make sure not to make any, we know what to look for on the future.
Yes.
Right?
Yeah.
But essentially on this deal, what ended up happening is right before closing, we had this jump shift and go to a bridge, right?
Yep.
We were a week or two from closing, and basically the lender made a mistake, and they didn't realize that, 2-3 years prior, previous ownership didn't do a great job of the property, right? And so that really messed up things. And so we had to go pick up the phone.
It was on a watch list, right?
It was on a Fannie watch list.
So that's what everybody needs to understand, right? If you're not looking this stuff up, right, that you could be on that blackball list that Fannie or Freddie might have of deals that maybe they're tired of, maybe they don't like, maybe something had happened in the past. So just a real quick story on what happened. This was a California group. They owned $1 billion in assets, right? So this was just one of many. It kind of been the forgotten deal, in a lot of ways. They didn't really pay attention to it. They didn't really have a whole lot of assets in San Antonio. And, the time that Fannie had come out, they were already kind of operationally challenged, but they were also going through a big rehab and the roofs were being replaced. And so the property just looked horrible whenever Fannie came out there to do their annual inspection, which they do, and they'll do it randomly. And so that plus the operational challenges that they were having got them put on this Fannie watch list. Well, unbeknownst to us, supposedly unbeknownst to the broker too, and I have to believe him and take him at his word. I don't think he knew either. The sellers did know, but they thought that the deal had been taken off the watch list once they had kind of turned the ship around, but it hadn't. Fannie's got a long, long memory, right?
And so, and ultimately, and I get it. I get why Fannie was concerned, right? So we had to go do bridge, pick up the phone, call every single investor, tell them the deal's changed. Luckily, pretty much everybody stayed in. And we did bridge, and that gave us an opportunity to do this refi, right? Because really at the beginning, we were contemplating, do we just do agency, do we do a refi? Because we knew we got it at a good price point. And so, really the deal was buy the deal, spend a year and a half, get the deal repositioned, spruce up the income and do the refi. And so ultimately we went through that. It was definitely, there was challenges along the way. Every deal has challenges, but being resilient, working through them, and kind of, I remember 8 months ago, it was like, man, we felt so far away from doing a refi, COVID, everything kind of going on, but luckily you kind of worked through it, got the property 95% occupied, humming along, doing really well.
Now we're 96.7.
96, yeah, I mean, and we've pushed income significantly, and more importantly, we've pushed the NOI. Right, and so fast forward to now, we've reached the light at the end of the tunnel, and we got the refi done last week, right? So with that, right during the refi, basically there's a step where they do an appraisal, right? And we basically increased the value of the property based on the appraisal a significant amount, right? $4 million. So if you kind of do the math, right? $4 million on a $18 million purchase. That's more than 22.5% probably, somewhere around there. So significant, right? So we did the refi.
And that's in 18 months, folks. Right? And in the meantime, there wasn't a ton of appreciation. Obviously, Texas is appreciating, right? But that really wasn't what happened here, right? We boosted the NOI through the operations, right? And so we forced appreciation in this property. And on top of that, we had put about $900,000 into it.
Yeah, $900,000 into it. So the delta's about $3.
So we had put some money into it. We had gotten the NOI up, and that's ultimately where we were able to get that higher value, for the refinance. But I wanted to point one thing out, because before we got all the way from there, just to get into the deal, it was not really a great bridge, man. We've had better bridge products than this.
I totally agree.
I think this was a deal that kind of this bridge loan got kind of crammed down our throats because of the timing of the situation. And ultimately the term was very, very short. It's only 20 months, which is not great.
22 months, I think. I'm not.
It was 20.
I don't remember.
Whatever. It's still not. It's still not great.
Still sucks.
What you really, just as a rule of thumb, everybody should at least try to negotiate 3 years with 2 1-year extensions, right?
Yeah. So we had the extensions. We did have extensions. We knew we had extensions that we could pay for, but those aren't free.
They're not free. And in this case, it would have cost us another $150K, which you do not get back. It's not like one of those things that gets refunded to you. It's just a fee. Right? So we were hell-bent on getting that NOI up and getting this thing refinanced before what happened.
Before what happened? Before COVID? Is that
before the election,
Before the election. Sorry, that's what you're talking about. Okay. Before the election, no. We wanted to get the refi done.
Drink some more of that coffee.
Well, no, you confused me because you said increase in the income. But yeah, you mean just get the whole refi done.
Yeah, we were
before the election.
We went crazy.
And I wanted to see what the 10-year looks like.
So folks, what was happening, right, is that we were humming along, right? COVID hits. The world's falling apart. We had this whole plan since the beginning, since we bought the thing, right? That we were going to do this in this fall, right? And we were still hell bent on getting it done. So we threw some more money into it. We got all the operations, where it needed to be for the refinance, and we were able to kind of get it across the finish line. But the challenge really was the timing of the bridge, right? And so you want to try to see if you can get a little bit longer of a term, give you a little bit more runway to increase the value even more, right? Because ultimately, I think it's worth even more than we'd appraised at. But for what we did in 18 months, it still felt pretty good.
Oh yeah.
So what did we get on the interest rate, man?
3.29.
3.29.
So good interest rate, and
12-year note on a 3.29. You're not going to get this type of debt. Well, maybe for the next few years.
We'll see what the world looks like. Right. You're never going to get this kind of debt 2 years later. You're never going to get this kind of debt.
No, but seriously, 2 years ago though, we were underwriting at probably 5.25. And so right now you're at 200 basis points lower than what we were underwriting this deal at, right?
Yep.
And so and you top that off with a little bit of cap rate compression, and you got a lot of good deals, right, that are happening right now. And so, but that wasn't the only thing. So we'll kind of go through the whole process, right? So ultimately, it's like an acquisition. So if for the folks that haven't done one yet, right, it's a lot of paperwork, right? You've got to provide your...
And Ben hates paperwork.
Despise paperwork.
I tell Ben, don't say no to things just because there's more work involved, Ben. Let's do the thing that's right. I know it sucks.
I know. This one's tough, though, because it's just like you have to pull data in from all over the place, right? So it makes us organized, though, right? You have to have your personal financial statement, so you have to have all your stuff up to date, right? How much net worth and liquidity do you have? And anybody that's trying to do deals should have this up to date at least once a quarter.
That's easy.
Just go ahead and keep it up to date. Keep your bank statements fresh. So whenever you do go to buy a deal or refinance a deal, you already have that all queued up, right? And he's a lot more organized about that stuff than I am. That's why this stuff makes me upset. But on top of that, we have to sign about 100,000 different documents, right? And most of this stuff you cannot DocuSign.
So you can try to DocuSign it and then see if it flies.
Yeah, most of the time you got to print it out and it has to be in blue ink. Right, you have to get a ton of stuff notarized. Luckily, Sharon here in our office is a notary, so that made things a little bit easier this time. But it's funny, it's like on any other acquisition, the lender knows about this thing for 2 months, and they wait until the last 2 weeks to really push things through, right? But ultimately, the lender got it done. We got a great interest rate.
Yep.
The one thing that I wanted to point out, though, is that refinances are a little bit different than they might have been back in the day. Now, post-COVID or during COVID, whatever we want to call this stage that we're in, right? You have to have escrows now. And the escrows can be anywhere from 9 to 12 months.
Just to be clear, you've always had to have other escrows, but there's a new escrow, right?
There's a new escrow, right? So you always have escrows for taxes and insurance. Yeah. And you'll always have some kind of a replacement reserve escrow, right? Those are always mandatory across any deal, no matter where we're at in the cycle, right? Now what they're doing after COVID hit is that they're making operators put 9 to 12 months worth of P&I in an escrow.
Even if you're an interest-only loan.
Even if you're an interest-only.
Full P&I.
Full P&I, and they're doing that as a way to essentially kind of mitigate their own risk, right? Whereas maybe COVID hits, again, we have a second wave, things get shut down, income drops, you can't cover your note. Guess what? You tap into that escrow. For people that have done a bridge loan, it's kind of like an interest reserve account almost, right? But you ultimately don't want to tap this, right? Because this is money that we earned as a property, and we want to give that back to our investors, right?
Yeah, so hopefully in 9 months, we can submit a request to get that money back. They'll do a little bit of a stress test.
I think it's still 12.
Ben thinks it's 12. Everybody, for the record, Ben thinks it's 12.
I think it's 12.
Luckily,
Ben.
I read the loan documents. It clearly says 9, but Ben doesn't believe the lender, so we're going to find out in 9 or 12 months.
We will find out.
If
it is, hey, I'll be pleasantly surprised. Right?
Yeah, 9 months we'll submit to do the stress test. They're going to do this test, make sure, I think it's like 1.31 debt service coverage ratio or something like that. So financially, property needs to stay strong, right? Mm-hmm. And we will get that chunk of money back in 9 months, and then that'll be essentially one nice big distribution out to our investors.
Yeah. No, I mean, so it's a good fair amount of money that unfortunately is kind of parked on the sideline. It's not some interest-bearing account. It's not making any money. It's what kind of stinks, right? But I get why they're doing it, right? They had, obviously there was a lot of people that took forbearance. There was a lot of challenges that our industry and commercial real estate in general had over the last 12 months. And so Fannie and Freddie, until further notice, are making everybody do this. So don't think that, I'm going to be able to just not have to do that. Mm-hmm. It's mandatory across all deals for Fannie and Freddie. And Fannie and Freddie both have different rules about it. This is a Fannie deal, so the rules that might apply for us might be different for a Freddie. So look into this. Yeah. But that's probably the biggest caveat that I'd have to tell people to look into whenever they're going to do a refinance, is that you will have that money wrapped up.
Yep. Totally agree.
So what else, man? Come on.
What else? And you have to pay your EIDL loan if you have one.
Okay, yep, closing. That's another thing. Great. Actually, that's a really good point, right? So on top of things that are owed, right, the SBA, obviously some folks took out EIDL loans. Some people took out PPP, right? PPP is not a big deal, right? Because most of the time your property management company would have done that on your behalf, and that's what happened here, But we did take out an EIDL loan, right? One of the property management companies that we had taken over from had left the property with a lot of AP, right? I mean, so you get stuck kind of like holding the bag. COVID hits, the world's coming to an end. The SBA has the EIDL loans, so we took one out, right? But it's a 30-year loan. It's a
beautiful loan, beautiful debt.
And I think the interest rate was like,
we use it to nuke the AP and get everything caught up and cleaned up, and the property is killing it now. But it's just, that's $500,000 that we were going to walk away with at closing, and they're like, no, we need you guys to pay that now. And so,
I mean, it's 6 1/2 dozen. You're going to have to pay it one way or the other, folks, right? You were never going to just be able to ride that out for 30 years.
I was going to ride it out for 30
years. He was going to ride it out. I wasn't going to ride it out. So we either got to pay it at closing when we sell, or Unfortunately, we had to pay it a little bit earlier, but it's all good, right? And we were able to bake that in, and we got it across the finish line. We still have a chunk of money that our investors are going to get in the next 9 to 12 months. So, that's kind of one of our deals. Is really it's our first refinance.
Yeah. We finally got a refinance. You're right.
Yeah.
We tend to want to sell instead of refi.
Well,
we also have a deal right now that we contemplated refi, but I think we will sell, right?
Hopefully.
Yeah.
I'm hoping.
So that deal is literally, hopefully we'll sign the PSA in the next week or so.
Yeah. So I mean, most of the time we're gonna take the money and go reinvest that into another asset or maybe 3. Right, but in this case, this is a nice big deal in a market that we love.
And then we think the deal has a lot more runway. That's the thing.
Of potential.
For our investors, we felt like it was the right decision. Right, the deal's got more runway, and now we kind of passed the big push at the beginning, and now it's just kind of fine tuning.
Yeah. And so we had challenges like every other deal, right? And the rehab, we had almost, like I said, about $900K that we had to do. So we did about 105 unit upgrades, and this was full blown flooring, paint, appliances, backsplash, the whole shebang.
Luckily not cabinets.
We've had some deals that we've had to do cabinets on too. And really they take that into consideration, right? A lot of what the lender is looking for is, how are you increasing the value, right? Because you could say, well, I spent $500,000 on roofs. That's not necessarily increasing the value. They just expect that to be done and to be looking good and to be functional, right? Just like HVACs. That's not necessarily increasing value. Now, if you're adding amenities, if you are upgrading units that are therefore going to drive rental revenue, the lenders are going to look at that very, very closely. But I was going to ask you, man, what was the other thing that they were really paying attention to because of COVID?
Just cash collections.
Well, cash collections and delinquency, folks. Yeah. That's important, right? You have to understand that right now during COVID, the lenders are going to be looking at every month, week to week, how much are you collecting? How much delinquency do you have, right? They're really, really paying attention to this because what people aren't really telling you is that there are some folks that aren't paying the rent. And unfortunately, because of the eviction moratoriums, that used to be our checks and balances as operators, right? Somebody doesn't pay the rent, they're gonna get evicted. Now, if somebody pays their rent, we can't necessarily evict them. And it doesn't mean that we won't be able to evict them later on, but currently, in a lot of jurisdictions, San Antonio included, you can't evict anybody. And even when you were able to, there's going to be a backlog for the next probably 3 to 6 months.
Yeah, so it's a little bit of a massaging process. So.
Yeah, so you just need to be aware that they're going to be looking at that when you go to a refinance.
Yeah, so for those of you tuning in, right, Money Mondays, we do this every Monday, 3:30 Central. Kind of usually it's 30 minutes all in, 20 minutes-ish of presentations, 10 minutes of Q&A.
Yeah.
So if anyone has any questions, please go ahead and leave the questions. We're happy to talk to them. We're pretty candid guys, pretty open guys. But kind of running through a few of them. So chat, hello.
Chat.
Iggy, hello. Long time no
Hey,
talk
Iggy,
as
what's
well.
up, buddy?
Let's see, Savion says, really to stop owners, operators from going into forbearance. A lot of properties went into forbearance during COVID. Yeah, I think part of it is...
Apparently they did. We didn't. But, I think that there was a lot of people that hopped on that bandwagon, maybe prematurely, because, I think back in March and April, nobody knew how bad it was going to be or how long it was going to last, right? I think everybody thought that the world was coming to an end, and we were concerned too. But we ultimately looked at the forbearance agreements and decided that the strings that were attached to that were just not worth it.
Yeah,
and
the
in this case,
was doing fine. So just forbearance, I guess maybe there's two schools of thought. Some properties were severely already sucking wind before COVID.
Yeah, I think that's probably.
I think those guys went for forbearance because it was the only out-ish. Yeah. Then you had other properties where you just don't know what the future holds, and maybe you're humming along, but if forbearance has no stipulations, hey, why not, right? Yeah. But then kind of once you dig in, you realize it actually doesn't make sense unless you actually need it. So.
And the one thing to point out too, folks, is, on a forbearance agreement, that was all very Fannie and Freddie driven, right? Not all the bridge lenders offered something like that. So, Rock, what are you doing back there, man? Are you breaking stuff? Come on. Don't worry about it, man. Don't worry about it. So mainly it was a Fannie and Freddie.
It says don't worry about it. It's not your phone.
You got the OtterBox on it. You're good. So not all the bridge lenders, including the bridge lender that we had, even offered forbearance. But what we're talking about is we saw it on other deals. I wanted to review it, but what you have to realize about forbearance is that you're one step away from being in default of your loan.
Yep.
You blow that forbearance agreement, you're screwed. And so people need to take that stuff very, very seriously and don't just rush into some kind of an agreement like that. Realize the ramifications that if things get worse, you're probably going to lose the property. And ultimately, also, when you do that and you go to another acquisition or you go to another refinance and they've noticed that you've taken forbearance on just one deal, maybe you have 10 deals, you've taken forbearance on one, it will be a black mark against you on acquisitions and on refinances. So you need to take that very, very seriously. So, but good point. Yeah, there definitely was plenty of those. So what else we got?
So let's see. So Savion continues to say, makes sense for lenders to find a way to cover themselves and be able to keep the note performing. The reason being because those are federal loans. Is that why you have to pay back a loan? No. So I mean, it's part of any loan agreement. There can't be any loans. Now that said, the thing we were trying to argue is that the loan is not securitized by the real estate.
It's not. It's securitized by us.
I think their legal just was pretty stringent about it.
Yeah, I mean, it was securitized by us and Disrupt Equity, and you probably could have made a case, but you're also rushing against the clock too, right? Do you really want to get this thing jammed up in some kind of legal proceeding, trying to fight Fannie Mae? And ultimately, after kind of talking with our legal counsel, he's just like, hey, this is what I'm hearing, that they're pretty much forcing everybody to do this, and so everybody just needs to realize it, because we know a lot of operators that did take out one. So if you go to refinance, obviously you're gonna have to pay that off, right?
Okay.
So, but yeah.
All right, let's see.
We don't got more questions?
Kathy says, love watching you guys. Thank you, Kathy. Appreciate it.
Thank you.
Savion says, how soon should you start discussing refinance with your lender? Good question. Sooner than later. I even remember whenever we started it, I was kind of telling me we should probably start it now, and we really hadn't realized that we were kind of already there, right? It was kind of like you start to realize, like, we knew when we wanted to do it, but it takes time to ramp up, get going, and get all that going.
It does, right? Especially if you're repositioning, you're rehabbing the property, right?
Yeah.
It's kind of maybe just having those discussions pretty early on with your lender, saying, where do I need to be to exit this deal, right? And they'll give you guidance, right? The bridge lenders don't want to get stuck with your deal. Trust us, folks. So they're trying to position that deal in the best possible light so you can refinance out and pay off the note that they have on it, right? So we did that, and luckily the bridge lender that we used was also the permanent debt lender, so they were incentivized obviously to get it done too. So they got their best guy on it, and and it was actually ultimately it wasn't too bad of a process. I think it was interesting because once again you don't realize that it's going to be almost like an acquisition minus the equity raise. And we didn't realize we're going to have all this paperwork done and all these things, right? But hey, you live and learn. Nothing got screwed up, and we got it across the finish line. And want to give a shout out to Anton Matley, Peak Financing. He did a great job kind of positioning. He's a best guy in the business when it comes to under-promising and over-delivering. And so he definitely got this one across the finish line with our lender, and we appreciate your help.
Absolutely. So let's see, who else has questions? So for those of you tuning in, Monday Mondays we do this 3:30 Central, right? Usually about 20 minutes presentation, 10 minutes or so Q&A. Q&A is the best part because I think it lets people ask whatever they want to ask. It doesn't have to be about refinance. Maybe that's one other thing. You guys can ask us anything you want to know. Right? We're pretty candid guys, happy to talk about anything that's interesting. So let's see. So Savion says, great info, guys. You're welcome. So thank you for being a trooper and kind of always catching the show. Yeah. For those of you that don't catch the show consistently, you should put it on your calendar. It's one of the best things to do, 3:30 Central, on a Monday afternoon.
Come on, who wants to get bombed on emails all day? Come on. I mean, we try to keep it light and bright, folks. As you guys can probably tell, right? We're very, very candid. We're open. We have nothing to hide, So we're just kind of shooting it straight with you guys about the things that we've done and seen and heard.
But in the meantime, if we don't get any more questions, what's coming up next week, Ben?
What's coming up? All right. Underwrite a multifamily deal with us. Whoa. Who came up with this?
We should get the whiteboard in here and just have Rock. We'll take the day off.
Rock, all right, you're up, buddy. You're gonna guest host some of this. All right. So we'll take a deal. Right?
So we had one question come in as well. Prasanna says, do you guys do your own property management? Yes, we do have our own management company, and it also does third-party management as well. So again, for us, it's been property management. We thought was a dated industry. We've been kind of rethinking that business.
What's it called?
Disrupt Management.
There we go.
We're very creative on the name. But it has the Disrupt name attached to it, so we care a lot about it.
No, just
make sure
Disrupt
we
TV.
perform. I mean, it's critical. So that business has been growing, really word of mouth, and so we do have our own property management company, and that's been huge for us.
I'm actually glad
on our deals.
Yeah, I was going to say I'm glad that we did this before COVID, because if COVID had happened and we were still under with the other management company that was already screwing us over, it would have been probably pretty bad. So we were able to be more nimble, be more creative, be more flexible in how we approached it. and taking care of our residents and working with them and ultimately keeping collections up. You know, and that's where a lot of people got jammed up during COVID, where they just had a one size fits all approach to collections and running property management companies. But over the last 6 months, 8 months, folks, it has been a different business.
Yep.
And you have to be nimble. So yeah, we're happy that we were able to make that change.
Then he asked for contact info. I'm going to go ahead and just put my contact information in the chat so you can grab it from there. But
absolutely.
With that said,
any other questions?
Any more question? And yeah, go ahead and send me an email, and I'm happy to kind of talk through it.
So what else am I missing, man? I know I went through a little bit of it. I know this is not, you can't do a 100% deep dive on these things in 30 minutes, folks. But we tried to give you the highlights, some of the challenges that we saw.
Any other big things about the refi process? No, I mean,
it's the same. Well, one thing, you still have title.
We can close the other. So our bridge lender did. That's something I was telling the team actually. The bridge lender made us use their bank account, but now we can get rid of that and use ours and use our process and our workflow.
Yeah, and I had talked to Jackie about that, so we're getting that squared away. But yeah, I mean, think of it like this, folks. It is an acquisition minus the equity raise. You still need to have title company to close the deal. You still need to have your lawyer.
Yeah.
There's a lot, not just reviewing documents. There's a lot of work that your lawyer has to do. It's still good to have a mortgage broker do these. It's all about positioning with these, right? You want to max out your loan proceeds, or if maybe you're not a max leverage type person, you want to get the best interest rate or maybe get some IO in there, you need to have an advocate there, right? The lender is not your best friend. They'll make it sound like it is, right? But they're really not, right? They're just trying to get the best deal from their side, right? And we like lenders, don't get me wrong, but you need an advocate there, and that's why we use peak financing. But across the board, right, it's the same thing. Yep. You're just not raising money, So.
All right, so with that said, it is coming up on 4 o'clock. So if anyone has any more questions, go ahead and leave them really quickly. Otherwise, we're about to call it a wrap. And again, reminder for those of you watching in, we do this every Monday, 3:30 Central. Mm-hmm. Check out our Facebook page, LinkedIn, whatever you want. We're there. What is our topic for next week again, Ben?
We're underwriting a deal.
Underwriting a deal. So,
so we'll kind of go soup to nuts as much as we can in a 30-minute slot.
Yeah. I'll push this guy off, and I'll bring the other bald guy on here that has a math degree, and we'll get this done. So.
Hey, what's wrong, man? I'm not allowed to be here? I'll sit on the side, all right?
But yeah, we'll kind of...
No, we'll have fun with it, folks. We're trying to educate everybody. That's the point of this whole thing. It's not up here for just us to jaw. We're trying to just let people do the business right and help people do that. So... and we also encourage you, if you guys have topics that you want to hear, once again, let us know. We're just kind of thinking through things that people might like.
Yep.
Right?
Absolutely.
All right.
All right, with that said, let's call it a wrap then.
Go ahead and
Thank
sign it
you
off.
all very much.
All right.
And we'll see you guys again next week.
All right, later.